Joining us now is Drew Matus, Chief Market Strategist at MetLife Investment Management. Drew, it's been a while. It's good to see you again. Welcome.
Good to see you, Kelly.
So I'm interested to hear that you're on the more, can I call it dovish side here? What do you foresee?
Well, we're on the dovish side because we're expecting a recession. You know, where I have some difficulty with kind of where the consensus is right now is the idea of rate cuts and a soft landing. When we have an inflation rate that's above 3, that doesn't square the circle. You know, if you were to kind of, I don't know, land on planet Earth and look at the United States economy and see a 3% inflation rate and an unemployment rate of 3.7, you wouldn't be asking yourself when we were going to cut rates. You'd be asking yourself when we're going to start increasing rates.
Right.
And I think, there's a bit of a disconnect in the consensus between, what people are thinking on the rate cut side and what's plausible in terms of what the Fed can tolerate with regard to inflation.
But why does your disconnect? It sounds like you're saying, forget all of that, focus on recession. It's still coming, and they're still going to have to respond to that.
Yeah, look, I looked at the unemployment rate today. First of all, the survey response rate was just abysmal. It was 50% of the people didn't bother responding. So, in terms of, prospects for kind of revision, this is the report that's going to get revised. But then if you go into the details a little bit more, what you see is that some things stayed the same, which was, about 25% of Americans who are working in this report actually saw a decline in their weekly wages, either because their hours got cut or, within the details of the report, they saw actual, declines in their average hourly earnings. So, in terms of, this is not a rising tide lifts all boats type report. This is, some people got to surf the wave in and other people are left stranded.
I'd like to dive in a little bit more on how you get to a recession scenario. If, as you just said a moment ago, you landed on planet Earth and you saw U.S. inflation at 3% and unemployment rate at 3.7% and payrolls gaining, you would say this is not the time to protectively cut interest rates in anticipation of a slowing economy. You would raise them because the economy is firm, inflation is still alive above the Fed target, and the job market is stable and solid. So how do you get from that forecast or observation of present conditions to conditions where you say the Fed is going to cut 6 times in 2024 because they have to do it protectively against a recession prospect?
I guess I would fall back on the idea that when things fall apart, they fall apart fast. When we have a long-term productivity boom, it's a long-term productivity boom. It happens gradually over time, and its positive effects are felt in the economy over a very long period of time. When the unemployment rate starts moving higher, it tends to move higher quickly. And so things fall apart, they don't gradually erode. And I think, as we look ahead, there are signs of weakness in the economy, and really the one kind of standout is the employment picture that's actually kind of working against that narrative. If you look at the ISM report, manufacturing's in recession. The service sector is barely treading water, according to that report. If you look at components of the unemployment report, they are showing increases in unemployment across a number of states. So, I know there's been a lot of talk of the so-called SOM rule for the United States, where if the unemployment rate goes up by enough, then it means the economy's in recession. If you do that on a state-by-state basis, you've got a number of states already in recession. You have more states in recession in November than were in recession in October. And if you kind of put it out on a map and look at it, it looks like a disease that's spreading across the United States. It's not, I think that when a lot of people talk about soft landing and we're talking about a recession, we might be talking about the same thing. It's just that I remember that a recession looks like something out of 1990 or 2000. And a lot of people don't have experience seeing a recession that didn't look like 2008 or 2020.
True.